estate basics. I'm going to teach you how rental properties make money. So, real estate basics, how rental properties make money. All right, so think of a stool. A stool has at least 3 legs, and on those legs, you're going to have cash flow, amortization, also known as principal paydown or paydown. You're going to have appreciation, and then there's tax benefits. So those are the legs of the stool. So you have cash flow, you have amortization, principal paydown, you have appreciation, and then you have tax benefits. So we're going to look at each one of these in detail. Now, one of the great things about rental properties themselves, and we're talking about single-family rental properties in this example, which is multifamily is part of this too, but we're going to look at single-family houses for now. So rent income, the house is rented. So you buy a house, and then what you have to do is, you're going to have expenses. So you have rent income, which generally I will look at annually. So $1,500 a month. Let's say we're going to buy a $200,000 house and we're going to rent it out at $1,500 a month. So then what we're going to do is take our gross scheduled income for the year. So 1,500 times 12 is 18,000. Now, we're not just going to have $18,000 at the end of the year. We have to take in consideration our expenses. So we're going to have our mortgage payment, which is principal, interest, taxes, and insurance. We're going to have repairs and maintenance, and then we're going to have our cash flow at the end of the year. So now, let's look at this example again. We buy a house for $200,000. It's rented at $1,500 a month. And when we're just going to assume that our principal, interest, taxes, and insurance is $985 a month. So if we have a house that's rented at $1,500 a month and our principal, interest, taxes, and insurance is $985, we're left with $515 a month in cash flow. Now, I'm not saying that that's easy to find, because finding houses that will cash flow positively can be very challenging. But for this example, I'm going to show you how these rental properties make money. So now what we have is we have the rent collected minus vacancy, repair, management fees. If you can choose to manage it yourself, we're just going to assume we're going to be using management fees here. So also delinquency, if people don't pay like they say they're going to pay. Now, once we deduct all expenses, we're going to be stuck with, we're going to have net operating income, also known as NOI. So we have our gross scheduled rent, then we have our $1,500 a month times 12 equals $18,000. Now let's look at the expenses in detail. So for vacancy, we're going to want to allow 1 month without rent per year. So generally speaking, on a 12-month year, we're going to take that, if it's rented at $1,500 a month, then we're going to take 1 month reserved for vacancies. So $1,500. So we're going to deduct 1 month's rent from the $1,500 gross scheduled rent. So $1,800 minus $1,500, we're left with $1,650. So repairs. Now, repairs can vary. It depends on the type of property. It depends on the age of the property, what kind of condition it's in, and what kind of repairs or what things you're fixing when you go in. But for now, we're just going to use $2,000 for the year. So $18,000 a year in rent, less $1,500 a year in vacancy, less $2,000 in repair. Now we have $14,500 is what we're left with. Now, management. You can choose to manage it yourself, or you can hand it off to a management company, especially if you have a full-time job, or if you have a business that you're running full-time, like a rehabbing business, a wholesaling business, whatever it is. So 10%, generally they're going to take 10% of the gross rent. So 18,000 times 10%, we're looking at $1,800 for the year. So now we have our $18,000 a year in rent, we have our $1,500 a year vacancy allowance, we have our $2,000 repair allowance, we have our $1,800 in management, and that leaves us with $12,700. So delinquency. Delinquency does happen. Generally speaking, delinquency or a set percentage of the gross rent roll being reserved for delinquency is more common in multifamily properties, but just to be safe, what we're going to do here is we're going to call it 2% of the gross rent roll. So that's $360 a year. So $18,000 in rent, less $1,500 a year vacancy allowance, less $2,000 repair allowance, less $1,800 in management fees per year, plus $360 in delinquency allowance for the year. That's going to leave us with $12,340. So mortgage and debt service is not part of this calculation. All right, so mortgage and PITI, P-I-T-I. So we have our principal, interest, taxes, insurance. So $200,000 is the loan amount. We're using $200,000 to keep it as an even number, a little easier to work with. So if you're just assuming that your rate is 4% some change, just for the purposes of this calculation, I use 4.26%, which is the interest rate on a 30-year fixed mortgage. The principal and interest comes out to $985. So you would have your $2,500 in, let's just say $2,500 a year in taxes, about $1,200 a year insurance. Now this is going to vary on what state you're in, what city. If you're in big northern cities, California, New York, Chicago, you're going to be looking at much higher premiums. But the point is, we have to crunch some numbers here to teach you guys how these things actually make money. So if we take $2,500 for the year and $1,200 for the year, and then we break that up into 12 equal payments, it's going to be $308.33. So now when we build everything in, that's going to mean our monthly PITI, our principal, interest, taxes, and insurance, is $1,293 per month. So now let's look at these numbers here. So look over on the left. So you have your vacancy, which is $1,500, and then you have your rent on the top, which is $1,800. You have repair $2,000, management $1,800, delinquency $360, and then your PITI at $11,820. And that leaves you with $520 for annual cash flow. That's not a lot of money. So let's look over to the right, because what we're going to do is we're going to take out management. So let's just say you decided to manage the property yourself. You're not going to pay that $1,800. So now we go down this column again, $18,000 in gross rent, $1,500 in vacancy. And let's do this. Let's, instead of the $2,000 a month in repair allowance, let's bring it down to $1,500, and I'll explain that in a second. We're not going to be using a management company. $360 in delinquency, and then our PITI is $11,820 for the year. So now our annual cash flow is $2,320. So one of the legs of the stool that I just told you about is having that $2,320 a year in rent. Now, a lot of times what you'll see is after you buy a property, especially if it's a property built after, let's say, 1995, it's a little newer, you already know that your HVAC is good, your roof is good, water heater is good, you shouldn't be dealing with major repairs. If you're not dealing with major repairs, odds are that $2,000 or that $1,500 repair allowance will not really have been spent, especially if you bought a house that needed some work and then you made repairs to it before you bought it. So that repair allowance, odds are that cash is going to be in the checking account, but for the purposes of this demonstration we're reserving money for repairs that inevitably occur. So it's normal to see more money in the checking account at the end of the year because these major repairs or these unexpected repairs have not occurred yet. So you should have at least an annual cash flow of $2,320 after the year, assuming that you only put $1,500 on the side and that you were managing it yourself. So cash flow is something that will increase over time, especially when you increase your rents, but we're just keeping this as a simple example. So now we have the second leg of the stool, which is principal paydown. So principal paydown, let's look at this pie chart here. So at the end of the year, when you made all your mortgage payments, you'll find that due to these amortization schedules in the first 10 years of the loan, the first 120 payments, most of the monthly payment goes to interest and only a smaller portion of that goes to principal. But at the end of the year, you will have paid down $3,166.56 in principal using the rent. So you paid down your loan with someone else's money. Now, that $57.24.52, that's going to come back again. We pay that in interest, but we're going to get some tax benefits for that. So let's go on. Now let's look at principal pay down year 5, because the first graph was year 1. Now, after year 5, with 12 monthly mortgage payments, we will have paid down $16,000, almost $17,000 in principal pay down using someone else's money, and we're going to have paid $27,000 in interests. So let's look at appreciation. Now, appreciation is difficult to account for because it's an unknown. We can never know what future appreciation is going to look like. But if we look at average rates, on average, after doing some research, it's about 3 to 5% per year. Now, in Wake County, when I first wrote this article, which I'm going to give you the link to, the appreciation rate was 5% from 2016 to 2017. Now, from 2020 to 2022, we're seeing 25% appreciation per year. However, there was one house that I bought it was about 2015. I bought it at 110,000. Now it's worth in the 300s. So we can't predict what appreciation is going to be, but I think 5% per year is very reasonable, especially in this current inflationary climate right now. So you will get appreciation. And why appreciation? Well, for one thing, you have a fixed supply of buildable land that you can build on. So there's a fixed supply of places to build houses. There's also a fixed supply of houses. And the costs of those houses are going to relate to construction costs. Inflation is going to play a role in there. The other thing is population growth. The United States has seen lots of population growth. We've seen a large exodus from the large cities down into the southeastern United States, where housing has traditionally been more affordable. So that's really what's going to fuel this appreciation. We won't go into too much detail in this video since we're keeping it simple. Now, equity. So if we look at the current valuation, because at year 5, remember, we had some appreciation that occurred each year. So now our house is worth about $210,000. The mortgage balance has been paid down to $162,000, and that puts our equity at $47,000 using someone else's money in the form of rent and appreciation, principal pay down, and this does not include our cash flow. So, tax benefits. Your mortgage interest is tax deductible. So at the end of the year, you're going to get a statement from the bank saying this is all the interest income, the interest that you paid. So at the bare minimum, if you work a W-2 salary job, you can deduct that from your taxable income. But if you have a rental property, you can use that interest that you paid with someone else's money to deduct it from the actual profits that you receive. So there's some tax benefits. Not going to go into this is not a tax video. That's a long and boring subject. The other thing is something called depreciation. Basically, as time goes on, you can depreciate the value of the house against the cash flow, and you get some tax benefits at the end of the year. They're very beneficial. That's a separate subject. And the other thing is a 1031 exchange. So there's a limit to the amount of depreciation you can take per house. Eventually, it will depreciate to zero after about, I think it's 27 years. Then what you can do is sell it and use a 1031 exchange to move all your equity over into the next property and not pay any tax on that money. I'm not going to go into that in that video, but there's tremendous tax benefits with owning rental property. If you like this content so far, hit the like button, subscribe to my YouTube channel. There's going to be a lot more content coming your way. And the other thing is a link to the full article is right down here. REI Tipster. So you just saw the 3 stools, or actually the 4 stools of cash flow, appreciation, principal pay down, and then tax benefits. So this is how rental properties make money. The more time that goes by, the better they get. A good analogy that I come up with when people ask me, well, those rental properties, they don't really make money, and the answer is that they do make money, but it takes a while. Think of it like a vegetable garden. First, you have to clear out the garden, you have to till the soil, you have to plant the plants, and you're spending money, and then time goes on. Organically, it's growing very slowly, and it takes a while to actually for those plants to bear fruit. And it takes a while to actually live off that patch. So keep in mind that rental properties are kind of the same thing. Now, we know that vegetable gardens, they grow a lot faster than trees do, but if you look at banana trees, and the other thing that's... what are those green things? Avocados, the avocado trees. I did a little bit of research on avocado trees. I think they take 12 years to actually start bearing fruit, or bearing the actual avocado. So think of rental properties like it's a tree. It takes a long time. What a lot of people do is they take excess income that they've saved from their W-2 job or from their business, and then they invest it in rental properties. And then when they have a portfolio of it, you saw the equity that I told you about, the tax benefits, the cash flow that you have, and then you have some substantial equity. That's when it really starts to, you start reaping the benefits, is long-term strategy, how these properties will make money. Now, Another thing is that you saw this example at property that was purchased for $200,000 that's rented for $1,500 a month. I'm not saying that that's easy, because if you go out there and buy a house built in, let's just say 2015, you're going to spend, the national average is like 300 and some change. You probably get maybe $2,000, $2,400 a month in rent. Is that going to cash flow with a standard or a normal down payment? No, odds are it's not. So what has to happen, and what I do, is I buy houses that need a lot of cosmetic work. So when I buy them, I'm changing carpet, paints, sometimes I'm redoing the HVAC, and I'm getting these houses at a discount. So I usually will have, sometimes my PITI is about $700-800 and it's rented at $1,500, sometimes $1,700. But then what I have to do is take that cash flow or the cash flow at the end of the year and compare it with what I initially spent, and that will you'll get into an ROI calculation. I'm not going to get into that now, but what you saw in this very brief presentation is that yes, rental properties do make money. They do so very slowly. The stool analogy, it's a great way to build wealth, and there's a lot of investors out there that have built a portfolio of 15, 20, 30 houses, and they live off their cash flow. Sometimes those portfolios have been paid down. There's no more debt over time. Sometimes there is some debt in there, but it can still be done. The thing is, you got to start today, and you have to be patient, and you have to think long term. Remember, like this video, subscribe to the channel. There'll be more content coming.